Have you ever wondered why some of the biggest market moves happen before the headlines catch up? While millions of investors continue watching daily price swings, a much bigger story may already be unfolding behind the scenes. President Trump is preparing major policy changes that could reshape the American economy. Jamie Dimon is warning about risks that many investors are still ignoring. And the Federal Reserve may soon face one of the toughest decisions in years. If these events collide, the impact on gold and silver could be unlike anything we have seen in recent history. Stay with us, because what happens next could affect every precious metals investor. For years, gold and silver have served as a financial safety net whenever uncertainty begins rising. Investors turn to precious metals during periods of inflation, financial instability, geopolitical tension, and slowing economic growth. But today the story is becoming much larger than a normal market cycle. We are entering a period where politics, central bank policy, and global economic shifts may all converge at the same time. The first piece of this puzzle involves President Trump and the possibility of major economic initiatives aimed at strengthening domestic manufacturing, expanding infrastructure, increasing energy production, and reshaping international trade relationships. Markets always react whenever governments introduce policies that influence spending, taxation, tariffs, or business investment, because those decisions directly affect inflation, economic growth, and investor confidence. If large fiscal programs move forward, they could stimulate economic activity while also increasing government spending. Historically, aggressive fiscal expansion has often placed upward pressure on inflation, especially when the economy is already operating near full capacity. Rising inflation changes the entire investment landscape because investors immediately begin searching for assets capable of preserving purchasing power. This is where gold traditionally enters the conversation. Gold has protected wealth for centuries during periods when currencies lose purchasing power. It cannot be printed by governments, and it has maintained value across generations. Central banks understand this reality, which explains why many countries continue increasing their gold reserves despite changing market conditions. Silver, however, tells a more complicated story. Like gold, it benefits from investment demand during uncertain periods. Unlike gold, it also depends heavily on industrial demand. This combination makes silver one of the most dynamic commodities in global markets. When investment demand and industrial demand rise together, silver often experiences stronger percentage gains than gold. Now consider another important voice in global finance. Jamie Dimon has repeatedly highlighted concerns surrounding persistent inflation, expanding government debt, geopolitical uncertainty, and long-term economic risks. While every forecast deserves careful evaluation, his comments reflect issues that many institutional investors are already monitoring closely. Government debt continues reaching levels never experienced before in modern history. Financing that debt becomes increasingly expensive whenever interest rates remain elevated. Policymakers therefore face an extremely difficult balancing act. They must support economic growth while also controlling inflation and maintaining confidence in financial markets. That challenge falls directly on the Federal Reserve. The Federal Reserve controls monetary policy through interest rate decisions and balance sheet management. Every statement from the Fed influences bond markets, stock markets, currencies, and precious metals. Investors know that even small adjustments in policy language can trigger significant price movements. During the past several years, the Federal Reserve aggressively increased interest rates to fight inflation. Higher rates strengthened the U.S. dollar, increased Treasury yields, and created headwinds for gold and silver. Although precious metals remained resilient, investors constantly questioned how long restrictive monetary policy would continue. Now that question has become even more important. Inflation has moderated from its highest levels, yet price pressures have not disappeared. Housing costs remain elevated. Insurance expenses continue rising. Services inflation remains persistent in many sectors. Energy markets remain vulnerable to geopolitical developments. Food prices continue affecting household budgets across the country. Meanwhile, economic growth has shown signs of slowing compared with previous years. Manufacturing surveys have produced mixed signals. Consumer confidence has fluctuated. Business investment remains sensitive to financing costs. Every new economic report now influences expectations regarding future Federal Reserve decisions. Markets never wait for official announcements. Investors constantly attempt to predict what policymakers will do next. If economic growth slows further, while inflation gradually declines, expectations for future rate cuts become stronger. Those expectations alone can influence gold and silver months before any actual policy change occurs. The US dollar represents another major factor that investors cannot ignore. Because gold and silver are priced globally in dollars, the strength or weakness of the currency significantly affects international demand. A weaker dollar often supports higher precious metals prices because buyers using other currencies gain greater purchasing power. Treasury yields also deserve close attention. When government bond yields rise, investors receive higher returns from fixed income assets, making non-yielding assets like gold relatively less attractive. But if yields begin falling because markets expect easier monetary policy, precious metals frequently benefit. Silver introduces another fascinating dimension because industrial demand continues expanding regardless of short-term market volatility. The renewable energy revolution continues increasing demand for solar panels. Electric vehicles require advanced electronic systems. Artificial intelligence infrastructure depends on sophisticated semiconductors, powerful data centers, and complex networking equipment. Every one of these technologies consumes silver because of its exceptional electrical conductivity. Unlike many industrial metals, silver also enjoys strong investment demand. This unique combination creates opportunities that very few commodities possess. If investors begin increasing precious metals allocations while industrial demand remains strong, silver may experience unusually powerful momentum. Supply conditions further strengthen this discussion. Most silver production comes as a byproduct of mining copper, zinc, lead, and gold. Mining companies cannot simply double silver production because prices rise. Developing new mines requires years of exploration, environmental approvals, financing, and construction. Supply therefore responds much more slowly than demand. Gold production also faces limitations. Discovering high-quality deposits has become increasingly difficult. Operating costs continue rising. Environmental regulations have become more complex. These structural challenges reduce the ability of global mining companies to rapidly increase production. When limited supply meets rising demand, prices naturally experience upward pressure over time. That does not guarantee immediate rallies, but it does strengthen long-term fundamentals. Investor psychology often determines how quickly these fundamentals influence market prices. Early in every major bull market, only experienced investors recognize changing conditions. Financial media continues discussing yesterday's stories, while institutional investors quietly adjust their portfolios. Eventually, price momentum begins attracting broader attention. More analysts publish optimistic forecasts. Retail investors return. Trading volumes increase. Financial headlines shift. What began as a slow accumulation phase transforms into a widely recognized market trend. Gold has already attracted significant global attention because of central bank buying and geopolitical uncertainty. Silver, however, still receives far less media coverage despite improving industrial fundamentals. History shows this situation has often preceded periods where silver begins outperforming gold. The next chapter of this story depends heavily on how fiscal policy, monetary policy, and economic data evolve over the coming months. If government spending expands while inflation remains persistent, the Federal Reserve may face continued pressure. If economic growth weakens too quickly, policymakers may eventually prioritize supporting employment over maintaining restrictive interest rates. That balance could become one of the defining investment themes of the next several years. Many experienced investors therefore monitor several indicators simultaneously. They follow inflation reports, employment numbers, manufacturing surveys, retail sales, Treasury yields, the dollar index, central bank activity, and commodity inventories. No single indicator tells the entire story, but together they provide valuable insight into where markets may be heading. This is why today's environment deserves close attention. Political uncertainty, economic transition, technological transformation, and monetary policy are all interacting at the same time. Rarely do so many powerful forces influence precious metals simultaneously. The biggest opportunities often appear before consensus forms. By the time everyone agrees that conditions have changed, much of the move has already occurred. Investors who remain informed, disciplined, and patient usually place themselves in stronger positions than those reacting emotionally after headlines dominate the news. What President Trump ultimately proposes, what Jamie Dimon continues warning about, and how the Federal Reserve responds will all play important roles in shaping the future of gold and silver. The answers will not arrive overnight. They will develop gradually through economic reports, policy decisions, and changing market expectations. And that is exactly why every serious precious metals investor should be paying close attention right now. One of the biggest misconceptions in financial markets is that precious metals only perform well during economic crises. The truth is much more interesting. Gold and silver often begin moving long before an official recession is declared, or before central banks actually change policy. Markets are forward-looking. Investors constantly price in what they believe will happen next, rather than what has already happened. That is why every major economic report has become so important. Inflation numbers, employment reports, manufacturing activity, consumer confidence, retail sales, and GDP growth all contribute to the larger picture. No single report changes everything on its own, but when several indicators begin pointing in the same direction, investors start adjusting their expectations. Suppose inflation remains above the Federal Reserve target, while economic growth continues slowing. This creates one of the most difficult situations for policymakers. If the Fed keeps interest rates high, inflation may gradually decline, but economic activity could weaken further. If the Fed cuts rates too early, inflation could begin accelerating again. Neither outcome is ideal. This uncertainty often benefits gold because investors seek stability whenever confidence in future monetary policy becomes less certain. Gold has survived wars, financial crises, banking failures, inflationary periods, and currency devaluations. That long history continues attracting investors whenever uncertainty increases. Silver may have an even more interesting story because it does not depend only on financial fear. Industrial demand continues supporting long-term consumption even during periods of moderate economic growth. Governments around the world continue investing in energy infrastructure. Solar installations continue expanding. Data centers supporting artificial intelligence continue consuming enormous amounts of electricity. Semiconductor manufacturing remains a strategic priority for many countries. All of these industries require silver. That demand creates a powerful foundation beneath the market. Even if investment demand fluctuates, industrial consumption continues absorbing significant quantities of available supply. If investment demand begins rising at the same time, the balance between buyers and sellers can tighten very quickly. Another issue that deserves attention is the global mining industry. Discovering economically viable precious metal deposits has become increasingly difficult. Existing mines face higher production costs, labor shortages, environmental regulations, and declining ore grades. Building a new mine often requires nearly a decade from discovery to commercial production. That means supply cannot instantly respond if prices suddenly increase. Commodity markets have repeatedly demonstrated that limited supply combined with accelerating demand can create significant volatility. Silver has experienced these conditions before, and many investors remember how quickly prices moved once momentum developed. The relationship between gold and silver also provides valuable clues. Many professional investors monitor the gold-to-silver ratio rather than looking only at individual prices. When the ratio becomes historically elevated, some investors believe silver may offer greater relative value. As market sentiment improves, silver has often narrowed that gap through stronger percentage gains. Of course, history never repeats perfectly. Every market cycle develops under different economic conditions. Today's environment includes challenges that previous generations never experienced. Record government debt, unprecedented. Technological expansion, changing geopolitical alliances, supply chain restructuring, and artificial intelligence are all influencing markets simultaneously. Artificial intelligence alone represents a remarkable source of future industrial demand. Every AI application depends on massive computing infrastructure. Those systems require advanced chips, high-speed networking equipment, efficient cooling systems, and reliable electrical connections. Silver remains essential in many of these technologies because of its unmatched conductivity. Electric vehicles tell a similar story. Modern vehicles contain far more electronic components than traditional automobiles. Charging infrastructure continues expanding across the world. Battery technology continues improving. Smart transportation systems require additional sensors, communication equipment, and electrical components. These trends support long-term silver consumption regardless of short-term market fluctuations. Meanwhile, central banks continue demonstrating confidence in hard assets through ongoing gold purchases. Although they generally do not accumulate silver, their continued diversification away from traditional reserve currencies highlights growing interest in tangible stores of value. Geopolitical uncertainty adds another layer of complexity. Trade negotiations, military conflicts, energy security, and regional instability all influence investor psychology. Whenever uncertainty rises, global capital often seeks assets perceived as stable and reliable. Gold usually benefits first, but silver frequently follows as investors expand their exposure across the precious metals sector. Another important consideration involves the U.S. dollar index. A strong dollar often creates temporary pressure for commodities because they become more expensive for international buyers. However, if economic conditions eventually weaken enough to reduce confidence in the dollar, precious metals could receive additional support. Treasury yields should remain on every investor's watch list as well. Higher yields compete with gold and silver because investors earn income from bonds. Lower yields generally improve the attractiveness of precious metals. Watching the relationship between bond yields, inflation, and Federal Reserve communication provides valuable insight into potential market direction. Professional investors rarely base decisions on emotions. They focus on probabilities. They evaluate multiple scenarios instead of assuming only one outcome. If inflation falls steadily while growth remains healthy, markets may perform very differently than if inflation stays elevated while economic activity slows. Preparing for several possibilities often proves more effective than making one aggressive prediction. This is exactly why the comments from influential financial leaders receive so much attention. When respected business executives warn about debt inflation, fiscal policy, or economic uncertainty, investors listen carefully. Their warnings do not guarantee future outcomes, but they encourage markets to examine risks more closely. The coming months may become some of the most important for precious metals in several years. Political decisions, fiscal policy, Federal Reserve actions, inflation, data, employment reports, and global events will continue shaping expectations. Every new development will either strengthen or weaken the investment case for gold and silver. What remains clear is that the market is entering a period where flexibility and information matter more than ever. Investors who continue following only daily price movements may miss the larger economic transformation taking place beneath the surface. In the final part, we will examine the realistic outlook for gold and silver over the next several years and discuss why disciplined investors may have one of the greatest opportunities of this economic cycle if they stay focused on the long-term picture. As we reach the end of this discussion, one message stands above everything else. The future of gold and silver will not be determined by one speech, one economic report, or one political announcement. It will be shaped by how all of these forces interact over time. That is exactly why today's market deserves so much attention. If President Trump introduces policies that increase government spending, encourage domestic manufacturing, reshape international trade, or stimulate infrastructure investment, those actions could have long-lasting effects on inflation, economic growth, and investor confidence. Stronger economic activity may support industrial demand, while higher spending could also keep inflation under pressure. The Federal Reserve would then face another difficult balancing act. If inflation proves more stubborn than expected, policymakers may hesitate before reducing interest rates. If economic growth slows more rapidly, they may eventually decide that supporting employment becomes the higher priority. Every decision carries consequences, and every consequence creates opportunities somewhere within the financial markets. Gold has always performed its strongest role during periods when investors question the long-term stability of currencies and financial systems. It has protected wealth through wars, banking crises, inflation cycles, and economic recessions. That history explains why central banks continue buying gold despite changing market conditions. Silver, however, may represent one of the most underestimated opportunities in today's market. Unlike gold, silver benefits from two completely different sources of demand. Investors purchase silver as a store of value, while manufacturers consume it for advanced technology, renewable energy, medical equipment, electric vehicles, telecommunications, and artificial intelligence infrastructure. Few assets enjoy such a unique combination. The world is becoming increasingly dependent on electricity, digital technology, and clean energy. Every expansion of solar power, every new electric vehicle, every advanced semiconductor, every AI data center, and every next-generation communication system increases long-term demand for silver. At the same time, mining companies continue facing supply challenges. New discoveries have become more difficult. Environmental regulations remain strict. Development costs continue increasing. Existing mines require constant investment simply to maintain production. These structural challenges cannot be solved overnight. When strong industrial demand meets rising investment demand, limited supply often becomes one of the biggest drivers behind long-term price appreciation. This does not mean prices will rise every week or every month. Markets always experience corrections. Volatility remains a normal part of investing. Successful investors understand this reality. They avoid making emotional decisions during periods of excitement or fear. Instead, they focus on economic fundamentals. They study inflation trends. They monitor the Federal Reserve. They follow Treasury yields. They watch the dollar index. They analyze industrial demand and supply conditions. Most importantly, they remain patient. Patience has rewarded investors throughout financial history. Those who constantly chase headlines often buy after prices have already risen sharply. Those who carefully monitor long-term trends frequently recognize opportunities before they become obvious to everyone else. Another important lesson involves diversification. Gold and silver each serve different purposes within an investment portfolio. Gold generally provides stability during periods of financial stress. Silver often delivers greater upside potential because of its smaller market size and industrial demand. Many experienced investors choose to hold both because each responds differently to changing economic conditions. The coming years may become one of the most interesting periods for precious metals in decades. Inflation remains an important concern. Government debt continues expanding. Central banks continue adapting monetary policy. Technological innovation continues accelerating. Geopolitical uncertainty remains elevated. Every one of these developments influences investor behavior. No one can honestly promise that gold or silver will reach any specific price. Markets are simply too complex for guaranteed predictions. Anyone claiming absolute certainty should be viewed with caution. Responsible investing is based on probabilities, not promises. What we can say with confidence is that the economic environment has become increasingly supportive for precious metals over the long term. Whether through inflation, concerns, currency, uncertainty, industrial demand, or changing monetary policy, gold and silver continue strengthening their position within the global financial system. Jamie Dimon's repeated comments about long-term economic risks remind investors that debt inflation and fiscal policy deserve careful attention. President Trump's future economic agenda may introduce additional variables that markets will need to evaluate. The Federal Reserve will continue responding to incoming economic data rather than following a fixed path. Together, these forces create an environment where flexibility and preparation become extremely valuable. Every major investment opportunity begins with information. Investors who understand the forces driving markets are often better prepared than those reacting only after headlines appear. Precious metals have always rewarded those willing to think beyond the next trading session and focus instead on the next several years. The biggest market moves rarely announce themselves in advance. They begin quietly while most investors remain focused somewhere else. By the time the entire market recognizes the opportunity, much of the move has often already taken place. That is why staying informed has never been more important. If you found this analysis valuable, make sure to like this video and subscribe to Silver and Gold Watch for more in-depth coverage of gold, silver, inflation, the Federal Reserve, the US dollar, and the global economy. Share your thoughts in the comments because we would love to hear your opinion. Do you believe President Trump's future policies could create a new bull market for gold and silver? Or do you think the Federal Reserve will keep precious metals under pressure for longer? Thank you for watching, and we will see you in the next video.